All righty. Good afternoon, everyone. Welcome to the Hurley Investments Market View commentary for the 11th of March. Notice down at the bottom there, my clock says 12 noon, 12 noon Mountain Standard Time, 2 o'clock Eastern Standard Time. I am doing this recording for you because my son just made the varsity soccer team. He played well over the weekend in a Las Vegas St. George tournament, and he has now been asked to play varsity for their first game coming up today. So I'm doing a recording so I can go watch my son do a varsity soccer. I'm sorry I won't have any live Q&A, but my email is khurley@hurleyinvestments.com. You may want to email me anyway because I have a couple things I'm sharing with you today that I've attached as handouts, and I will have next week in our Market View commentary as handouts, so I can download it then. But I have some attachments for you in regards to analysis. So if I was to ask you which is most important, fundamental, technical, or sentimental analysis, how would you answer? And most people would say technical analysis is really, this is the short term. This is the short-term analysis. And when you're talking about short-term, you're usually talking 30 days or less. But technical analysis is the short-term analysis. Sentimental analysis equals the now analysis. This is even shorter than short. This is the news-driven, the 1 to 3 day analysis. It's sentiment. Sentiment changes like the wind blows. But this is a sentimental analysis that is short term, that goes one way or the other. And then fundamental analysis, in all reality, this is the one that trumps all and means the most long term. You want to trade a fundamentally sound company. You want to trade a fundamentally sound company so that if there is something that is wrong, you can wait for it to come back. Technical analysis, again, is short term. There are some longer term trends. We look at the 20 and the 50 day, but fundamental analysis is where it's at. In fact, fundamental analysis, I have created a spreadsheet for you that looks something like this. I think a company will be fundamentally sound if I can check mark 10 to 11 of these 14 boxes. And these 14 boxes are institutional ownership, average daily volume, dividends, high low, is it within 10% of the low or the highs, debt to equity ratios, overall debt, revenue growth rate, earnings surprises, profit margin, PE ratio, PEG ratio, sector growth, rank in industry, beta. These are all things that I'm looking at. Kevin, where do you get these from? I get these usually from FinViz. FinViz, and if I was to type Apple in here, this is where I'm getting my information from. They're just numbers. They're just numbers, but they're numbers that mean a lot to me if you're willing to do the work. Book to share, cash to share, the PE ratio. This is where I grab the forward PE ratio for where it's going to be in the future. Long-term debt to equity, where it's at. Earnings per share. I really like return on assets, return on equity, return on investment capital, gross margin, institutionally owned, 61%. These are things that I'm looking at for making a decision if a company is fundamentally sound or not. And I probably shouldn't use Apple. It's not one of the better ones because obviously they have so much cash on hand, right? That you can easily see that that it's a fundamentally sound company. Just in case I didn't point it out, the volume is hidden right here. But there's certain things that I'm doing in a checklist to verify that these are fundamentally sound. And it's pretty easy. Institutional ownership. I want to know that it has 50% or more institutionally owned. I really would like to see it closer to 80, but above 50% is important, and I'll check mark it off. For liquidity, average daily volume, does it trade more than 1 million shares? I'd love to see it at 5, but 1 million's my minimum. Dividend, does it have a dividend? It's not a breaker count, but for me, it does count as one of the 14 to tell me if a company is fundamentally sound. If it does like Apple, I'll check mark it off. A high end, low end. I don't want it to be up to the top 10% of the high end of its value because that is an overbought signal. I want to see it maybe down towards the low end or in the middle of its range between its most recent highs and its most recent lows to see if we have an opportunity for it to move higher. You typically don't want to buy a stock at its highs. You sell high, you buy low. I'm willing to be somewhere in the middle to purchase a stock or a position in a company stock. Debt to equity, it's just a number. 0 is the best. You want to see it be somewhere in the industry and sector average. Higher than the industry might be a bottom of the barrel type of stock. Something you should be considering. Overall debt, obviously it goes with the debt to equity as well. I want to see revenue increases. I want to see earnings surprises where they beat maybe on a constant basis. Obviously, profit margin, PE ratios, PEG ratios, all should show growth. Industry growth is that return on equity, return on assets, return on investment capital. And then I go to Yahoo to take a peek, because if you're just writing down a bunch of numbers on a sheet, if you just have a bunch of numbers written down, it doesn't tell you anything. You might want to go to Yahoo and compare it to sectors. You might want to do your research on Apple and see how it compares to trending tickers, Meta, Monster, Boeing, Moderna. You need to go through your statistics and make sure and do the extra work, not just fill out a form, but compare it over time. Compare it to the industry. Compare it to Meta, to Google, to maybe Verizon. These are just numbers. If you just write numbers down on a piece of paper, that doesn't help you out. It doesn't tell you all of the information that you need. You want to compare it to the industry, the sector, and the maybe a couple within that group of stocks you trade. I like the financials. Just because you have a check sheet of 14 things you can check, go deeper. See their total revenue, see the cost of revenue, see the gross profit in the billions for Apple. Dig deeper. This is your fundamental check. You're fundamentally checking companies to see if it's a company you want to own that will get you to retirement. These are the things you need to be doing when you do fundamental analysis. I like some of the analysis sectors. I do think it's kind of interesting. Low, high estimates, revenue estimates, earnings history. These are all trends that you should be paying attention to. This is the research that you want to understand how your company is doing. Let me go to Apple through Google. You can find a lot of the same information on Google. A lot of the average volume, PE ratios, and so forth. I do like Google because you can compare to, and it gives you Amazon, Microsoft, Tesla, and NVIDIA. There are stocks you can compare Apple to, Intel, Alphabet, Palomar, and the S&P 500 Trust. These are the ones that you can be looking at to verify if your stock is the stock that you want it to be. You've got to compare it. You've got to look at it in regards to its competition. It does you no good just to fill out a form and start putting numbers in here if you don't have something to compare it to. So that's the part that most people miss. Well, it has better than 50% institutional ownership. They just do a checklist. Life is more than a checklist. Fundamental analysis is more than a checklist. It's making sure that you found the reasons to own it, and then it's going that extra hour and a half maybe of due diligence to verify that your information means something, that you're looking at what you want to see for earnings or growth. And understand, there are times when the fundamental analysis will look fabulous, but that doesn't mean the stock market's going to appreciate it. If we went to Meta down big today, can't spell, and it hit its daily average volume in the first 2 hours of trading. So the question is why? What is the problem with Meta? Well, it's down $19.28. It was down as much as 30. If you take a look, if you own shares were down $9,627. We were making up just over half of that with those short calls. This is why we had those short calls in place. They're out till April to get us through our tax selling. They're to get us through our well, up to our next earnings season. We did a really good job protecting Meta by taking a credit in instead of spending money with those long puts. Now, if you had the 460, 380, 360, 400 calls, we're only down $159. You still have a lot of profit. In the new 470, 540 calls, we're still profitable, but it is down big today. In the new 520, 600 calls that we put out, this one's down quite a bit. Down on Friday when we put it on, down today, but we have all the way out till January 2025. We're not too worried about those calls whatsoever. It's a big down day on Meta. It's a down day on the fact that NVIDIA is getting crushed on some reports that AI firms have moved too far too fast. Excuse me. It's also down on the fact that Trump went after Facebook. Went after Facebook today and made some comments that he felt Facebook was not fair during the election. So that's what's happening with Facebook. That's the problem with it today. And, the short answer is it's nothing but a thing. It's a blip on the radar, and hopefully we'll get through this relatively quickly. If you ask me, I would say for the amount of volume, it's just a fund that is moving out. Thank goodness Meta has its $80 billion buyback, because that's what I think is kicking in. And it would not surprise me to see Meta peg at 500. What does peg at 500 mean? It means that it can't get above it, can't get below it. I mean, there might be a range of $10 one way or the other, but it builds a base. We're looking at Meta building a base because it has moved rather quickly, rather far. If I go ahead and bring out Meta here for you guys in a chart, it wouldn't hurt for Meta to build a base. It wouldn't hurt to see Meta have the opportunity to flatten out. Well, Kevin, it looks kind of flat, right? I see hey, it looks kind of flat. Not really when you're talking about 80 bucks. We want to see it flatten out. 500 would be ideal. It's a round number. It's a good spot where you can see the stock buyback go into effect. It wouldn't be a bad place to see Meta peg or be at that number for the next earnings season. So that's what I see on Meta, and that's why I'm looking at it right now in that position. Okay, let's keep going here. If you want those analysis sheets, if you want a copy of the analysis sheets, email, almost got it, email khurley at hurleyinvestments.com. Hurley at hurleyinvestments.com, and I will get the copy of those two sheets off to you just in a PDF format. If you want to wait till next week, I'll have them in a PDF format attached to the GoToWebinar, and you can definitely pick them up next week. Big picture. Big picture is all about inflation. In the most recent semi-annual monetary policy testimony for Congress, Fed Chair Powell said, there is no evidence or no reason to think that the U.S. economy is in some kind of short-term risk of falling into a recession. It's not there. The risk is in the inflation. The risk is in the inflation because the labor market seems to be in good shape. Now, I have an article down here, and I'm going to go to the article really quickly. Powell says it's not far from the point of cutting interest rates. Well, where will they cut? They're probably looking for 3 months of CPI heading lower. If we do the 3 months, we're going to have March, April, May, which means June would be its first month of cutting. The problem is May, CPI usually goes up. If I was to ask you, why does CPI go up in May? It's the start of the summer season. A lot of prices for things that people will need, beach towels, beach chairs, barbecues, fertilizers, home repair, outside home repair for fencing, everything seems to go up. So we're sitting here at a point in time thinking, okay, maybe he's not going to raise rates until later. Maybe there's going to be a bit of time that he can't raise rates because he just hasn't seen what he needs to see. 3 months with CPI numbers coming down. The CPI numbers do not look like they're going to come down tomorrow. The CPI is at 0.4. The core CPI is at 0.3. That does not look like inflation still going up. Well, is it going to be less than the 0.7? Probably, right? I think it was at 0.7 and 0.5 last month. Yes, it'll probably be less than that. But will we see a reduction in inflation 3 months in a row? Probably not, and it's because of historical cycles, in which case we might not get a rate cut until July or later. It might not happen at all this year till after the election and a big rate cut in November, December. Just things to pay attention to. Yeah, maybe I should do that. One other interesting factor. Pretty sure I took a screenshot of this. If I was to ask you, where's all the growth come from the last year and a half? It would be easy to say, hey, the Magnificent Seven, right? We have had some extreme concentration in our market at certain periods of time. Some of these were related to war. Some of these were related to oil. Some of these were related to tech bubbles. Some of them are financial bubbles. Some of them were Great Depression, where everything was going bankrupt in 1932, and only a few core financial stocks were making money. There are individual reasons to understand extreme market concentration. But right now, we are at one of the highest periods, higher than the Great Depression, on an extreme market concentration on market growth. And it's really down to 7 or 9 stocks, depending on how you look at it, where the growth has been pushed significantly. I'm only pointing this out because it's an abnormality. That's why we're lessening our Apple shares. Well, Kevin, you lessened some at 185. It was trading at 200. It could get to 213. It's now trading at 160 something, right? Let's see where Apple's trading exactly. It's now trading at 172. So yes, there are times when we're loading up and we're not going to get the highs of the highs or the lows of the lows. But we do have a fully valued stock. And when you have a fully valued stock in Apple, it's probably a good idea to lessen up on it and to find something like Micron to be in, which is not fully valued. Apple is still a good stock, but we're looking for opportunity. And there's not a whole lot of opportunity in Apple at this point in time. It's one of the Magnificent Sevens. It will probably go down. Meta, we're getting out of Meta at 500. It's more than doubled in the last 2 years. It's time to take some profits off the table. For a while, some people were like, Kevin, I don't want to get called out at 500. Why? It's trading at 486. You'll get called out $14 higher. You'll take $9.80 of credit. That's a great place to get called out. It's okay to take a profit. We've got other positions that will continue to make upward movement on the stock. Pigs get slaughtered. Don't be a pig. Go ahead and take some profits when it's right there glaring in your face. Am I taking a profit because of this chart? No. But this chart should mean something when you see extreme market concentrations in certain areas. You're ripe for a correction, a pullback. So we're being a little overly protective, and we're going to keep doing so. Something else to remember. The falls are quick. Well, Kevin, why don't you just take a profit, because it's profitable? I'd rather miss a little of the stock coming back, because market falls are quick and it can fall dramatically. Yeah, I might miss $1 or $2 as it starts to come back. I'm okay. As long as I make a big portion of that downward movement, not all of it, not 99% of it, not 95%, as long as I make some portion of that downward movement, it's a profit for us on the back end when things get higher or when they return to those prices. So please, just because you have a profit, it's okay to lose a day or two to prove that we're going through a trend. One day does not make a trend. Well, Apple's been up 3 days, but it's barely been up. It's okay to miss $5 up when it has another 20 to still go. Let the trend prove itself. Okay, this week, what will our markets end this week? I pulled out a couple charts, and the charts are for today at noon Mountain Standard Time, roughly. If you look at the Dow, it's still slightly bullish, but some could say we're rounding off. We're building a base. It's indecisive. We're still technically bullish in some areas. We're bearish in other areas like the MACD, the 1% R. It's undecided, which means it hasn't crossed over to bearish yet, but it is still technically bullish, just barely. More importantly, look at the S&P. The S&P is a better example of our stock market. The S&P is also looking like it's turning bearish, but we're more bullish on the RSI. We're more bullish on crossovers. The MACD is laying on each other, and we're still technically bullish on the Williams %R. So we're still bullish. We're just taking a bit of a breather 2 days in a row. NASDAQ is going to show the same thing, but the NASDAQ is a little more exaggerated. And it's a little more exaggerated because more technology companies, it moves a little faster. Still bullish all the way across the board. So we have a little bit of time to be patient for just a small correction. Could it go down to the 50-day? Of course it could. I mean, in real life, yes. We could see the stock come from 1602 and touch the 15516 mark. But look, it's just doing the same trend. Higher, low, higher, low, higher, low, higher, low. Could we have a double top? Maybe. Could we have a triple top? Maybe. Or could it be that people are harvesting profits from the Magnificent Seven for tax selling reasons, which give other people an opportunity to get in? When a stock goes on sale, there's no reason to run for the exit. Little bit of patience. Earnings this week. Oracle and Vail, Kohl's on Tuesday, Dollar Tree, Lennar on Wednesday, Dick's, Dollar General, Adobe, and Ulta on Thursday, Buckle and JBL on Friday. Pretty light third retail sales week is really what's happening. Economic reports, CPI tomorrow, PPI on Thursday. Those are going to run our week. We were down last week, worst week since October. It was only down, 0.3%, maybe 0.3%. Not the end of the world. Looking to trade, still have protection on, right? Still have protection on. And really to get through CPI inflation numbers. Then I might take some off on Disney and on Baidu, on Apple. Interesting article, something I want to make you guys aware. Biden's $7.3 trillion budget for 2025 calls for taxing the rich and corporations to pay for Social Security. I'm a little disappointed as I've gone through what it all says, and it really comes down to this reason. And here's where you're going to realize that you guys are all considered rich. They want to tax unrealized gains, which is just the dumbest thing in the world. Where can I find it? I read it somewhere in here. I read it in the tax bill itself. Line of trillion. There it is. They want to do a minimum tax rate of 25% on unrealized income of the very wealthiest households. The problem is most of us might be playing a 10 or 15, but that means if you owned Meta, you pay a mandatory 25% tax rate. This means if your house gains money, right? If you get an increase in the value of your house, like mine did a couple years ago, I would have had to have sold my house. I couldn't afford to pay the tax rate of 25% on how much my home is appreciated in the last 10 years. This is one of the dumbest things I've ever heard of. Taxing unrealized gains, because it could be a gain one year, a huge loss next year. You've paid taxes on a gain that you never cashed in and saw those profits on. I can't explain how stupid this idea is. Yes, it is one way to attack the rich, but it will decimate the retirement for middle America, for anyone that owns a home, for anyone that owns a 401k, for any money that's in the stock market that we're trying to grow for our retirement. If this bill passes, we are all screwed. I don't care if you like Republicans or Trump, or you're the biggest fan of Joe Biden. This particular issue of a minimum 20% tax rate on unrealized gains is saying we're going to take a quarter of your potential profits, whether you've earned it or not. And it just doesn't make sense. It doesn't make sense at all. So remember that when you vote. Guys, thank you for letting me do this. Thank you for letting me do this early for you guys and getting out to you via a webinar, a link, a YouTube video link. I'll get this out to you. I will look forward to seeing you guys on Thursday, and I will be doing this next Monday. But I'm kind of excited to see my son, a junior in high school, play in his first varsity soccer game. So I appreciate you guys giving me that opportunity. Thank you very much. Have a wonderful evening. And I look forward to seeing you guys on Thursday morning or next Monday. Goodbye, everyone.